We have just gotten the comments from Fed Chair Jerome Powell. The embargo was lifted. Market is looking at that. That has got the markets taking off. Edward Lawrence is with me live right now. Edward.
Yeah, and I've gone through these comments, and what is moving the markets is the fact that Federal Reserve Chairman Jay Powell is saying that it might be appropriate to moderate the pace of interest rates at the December meeting. He's saying that they will hold the restrictive policy for some time, but signaling now a more moderate Federal Reserve coming in and slowing down to check on that lag effect. He does talk in the speech about the lag of monetary policy and how, it takes about 6 to 9 months in order to feel the effects of it. He does say it might be appropriate, again, to moderate the pace of the rate increases at this meeting. He goes on to say that he's cautioning against premature tightening, or against moving down prematurely in the tightening. He's cautioning, saying that they're going to hold that tightening stance for some time, but again, slowing the rate of increase as they get closer to that restrictive stance, he says. He obviously says inflation is much too high. That is where his focus is. He also talks about Fed will stay the course until the job is done. They're trying to make sure that the expectation doesn't change of being around 2% target. He says, again, Fed saying here it will take substantially more, and that's a quote, evidence that inflation is declining. He does talk about the last inflation report that came in to the positive side, surprising to the positive side, saying that, hey, maybe it's moderating a little bit. He does caution, though, that one report does not make a trend, and the two reports before that, surprised to the downside, was negative in terms of where inflation needed to go. So again, Cheryl, this is going to, this is wanted to hear. They wanted to know when there might be a moderation of it. We're getting that signal now from the Federal Reserve Chairman Jerome Powell that possibly December they will go 50 basis points and then possibly look to see where they are in the beginning of next year, because they are saying that this lag effect, they want to see how that's affecting the economy.
A couple of things I want to ask you here, Edward, in particular, and I'm glad you brought that up. I was really interested to hear him say time for moderated rate increases may come as soon as December. I think that's a very key line, and you definitely highlighted that, and I'm glad you did. But the other thing, and just want to turn your attention back to the markets. Now the Dow is actually down about 60 points. We got this initial pop when these comments first crossed. Now the Dow is actually turning negative. NASDAQ's still strong, up 76. Technology stocks still a lot more sensitive, obviously, to rates even really than the Dow 30 would be. But I think the labor market component of this is very interesting because, he's doing all they can, I would say, to destroy the economy, right? You're trying to push everything down. We had 2 quarters of negative growth. But at the same time, even with that ADP number today, Edward, and we've got the jobs report on Friday, we still have this tight labor market. How does he balance that? That seems to be a very tricky road right now.
What's very interesting in this speech, he talks at length about the labor market. He talks about how retirees have been leaving the workforce at a greater rate, and that has caused a problem with the labor force participation rate. He said, again, the older retiring workers at a higher rate, and he sees some of those retirees coming back with inflation, but not enough to sort of offset that. He also alludes to the fact that wages are rising more than what should be necessary when you look at a 2% longer run. And that's a concern because that obviously indicates maybe the wage price spiral. We have to ask him about it at the next meeting. But what he's saying that is basically they would like to see wages, the increase in wages, come down a little bit to match the labor force that is out there, because right now wages are increasing more than what that 2% target should be in the future. And so they're very concerned about where the labor force is, how many people are in it, how many people are leaving, and why it's not moving. He says it's basically moving sideways as opposed to growing with that labor force participation rate, and that's a concern for them. He also talks about the GDP in here. He says that we'll see below trend growth going forward, and we need to see below trend growth going forward for some time to help bring down inflation.
That's going to be interesting to see, too, since we just got another read on GDP this morning, and it was 2.9%, which was higher than the first read that we've gotten. The other thing, too, Edward, real quick before you go, is this, on Friday we're going to get the November jobs report. There is going to be wage data in there. So I'm wondering if we're going to see a little bit of a change for this report. I don't know.
what's been happening over the past several months with those labor reports is that the average hourly wages, the year-over-year wages, has been slowly declining. Now, the Federal Reserve would like to see that. Obviously, they want to make sure that workers are making more in general, but they want to see that decline come back down to where historical trends should be for that longer 2% growth. Because if you have wages too high, companies will then be forced, as you know, to pay more for their products because of the wage component, and they'll pass that on to customers. And that's a sticky inflation that the Federal Reserve is trying to deal with in this. And he does address some of that in here. But again, the Federal Reserve Chairman saying that it might be time to slow some of this tightening just to see where they are. He's not saying stop it. He's not saying bring it back down. He's saying slow to pause sort of where they are in the environment as they do believe that restrictive policy should be continued for some time.
Well, again, you know, looking at Fed funds futures, I mean, anything any comments that he makes, and I was just looking through this, we've got Fed funds futures now tied to that December meeting, 75% chance of a half-point rate hike, 25% of a 75. So Wall Street has now changed their betting strategy even more. They're even going more so that we're going to get 50.
You know, and one more point on this. You talk one more point on this. Core inflation reigns big in this speech, what the Federal Reserve Chairman is going to talk about. And he's saying core inflation has been moving sideways, and that is not basically what they want to see. They would like to see core inflation come back down, and that relates to that sticky inflation they can't get rid of, and that could be the concern in the market. So you have the top line where, hey, there might be time for moderation in rate hikes in the December meeting, but then you have this core inflation, he says, which has been a problem for the Federal Reserve, because in the speech he alludes to the fact that they should have seen some of that core inflation come down with the amount of tightening they've done, but it just hasn't happened, and they're sort of scratching their head as to trying to figure out why.
No, I agree with you. You know, we got to run, but I'll tell you what, whenever CPI crosses, I know that we talk so much and give all the attention to the headline number, but you're right, the core on CPI, the core on PPI, that is where the real decisions are being made, to your point. Edward Lawrence, thank you so much. Really appreciate it.
Thanks, Cheryl.
All right.
Thanks.